Well, it turns out we might someday get to see a dividend-paying investment that pays distributions every single day, or at least that appears to be the direction we're now heading down. Because it was just recently announced that investors will be getting 3 new high-yielding ETFs that claim to have the objective of paying dividends not once a week, but twice a week. This is according to the information that was submitted to the SEC, which are in documents that are now available to read on the Edgar database. The company behind these new funds claims that they intend to pay shareholders dividends twice a week, and I say will because they haven't yet been released. But based upon the documents that were submitted to the SEC, we can already get a good understanding of what we can expect from these ETFs when they do come out. So in this video, we'll go through the documents of these new investments and see what kind of strategy they'll use, what we can expect in terms of a potential dividend yield, and if they're worth considering for high-income investors. But regardless of the strategy they'll use, I think it's pretty exciting to have an investment that pays investors twice a week. Based upon my research, the very first monthly paying dividend stock was introduced 56 years ago, and that happens to be Realty Income, and to this day, they're still raising their dividends on a regular basis. Then in 2020, we had the very first weekly paying investments. Those were launched by the company SoFi, who introduced tickers TGIF and WKLY. These funds did not receive much attention because they offered significantly small dividend yields, and they were ultimately delisted due to a lack of interest. Then about 15 months ago, 2 new weekly paying ETFs were issued by the company Roundhill. Those were ticker symbols QDTE and XDTE, which are both 0 days to expiry synthetic covered call funds on the Nasdaq and the S&P respectively. These 2 ETFs would prove to be much more popular when compared to what SoFi offered, and they both attracted hundreds of millions of dollars from investors as of the making of this video. Both Defiance and YieldMax saw what Roundhill was doing, and they both submitted updated prospectuses to the SEC to switch from paying monthly dividends to weekly on some of their already existing ETFs. And now, looking at the very near future, we will apparently very soon have the first investments that pay twice a week. When these weekly dividend ETFs were first introduced, I know a lot of people joked about whether or not we'd someday have a daily paying fund. And based upon the direction we're headed, I think that could eventually be the case, or at least 3 times a week, like Monday, Wednesday, and Friday. So, like I said, we have their SEC documents, and we can get a pretty good idea of what to expect in terms of a strategy and dividend yield from these funds. This ETF provider isn't brand new to the high-income space, it's Defiance. They're the ones that are going to be behind these new twice-a-week dividend ETFs. Let's go look at the fund details. The document where all this information is coming from is from Form N-1A that was released on May 23rd. We can see the names and ticker symbols of all 3 ETFs at the top. The first one is the Defiance Nasdaq 100 Lightning Spread Income ETF, which will trade under the ticker symbol QLDY. Then there's also the Defiance S&P 500 Lightning Spread Income ETF, ticker SSOY, and the Defiance Russell 2000 Lightning Spread Income ETF, ticker IJRY. This document contains all of the information regarding their strategies and dividend policies, which are all the same. As you can also probably guess, they'll all use the exact same strategy on all 3 of the major indexes, which are the S&P 500, the Russell 2000, and the Nasdaq 100. Let's dig a little deeper, as it looks like whatever Lightning Spread is going to be some kind of brand of Defiance's ETFs. It says, the fund's primary investment objective is to seek current income. The fund's secondary objective is to seek capital appreciation. We can also see a breakdown of the expense ratio. They anticipate this ETF coming with an expense ratio of 1.04%, which is a little steep but comparable to other Defiance ETFs. Under Principal Investment Strategies, it says the following. The fund is an actively managed ETF that seeks current income and secondarily capital appreciation. The fund seeks to achieve its investment objectives by employing a lightning spread strategy, which is designed to generate daily income that the fund intends to distribute twice weekly. The fund strategy also seeks to provide long exposure to the price return of the Nasdaq 100 index. To implement this strategy, the fund will utilize put and call options that reference the index or on passively managed ETFs that seek to track the index's performance. For simplicity, a reference to the index includes index ETFs. Additionally, the fund will invest in short-term U.S. Treasury securities and money market funds to enhance income from uninvested cash. So what exactly is this lightning spread strategy that this company even decided to trademark? There's a section in the document that describes what this is. The fund synthetic lightning spread strategy involves a combination of buying long-dated, deep-in-the-money call options on the index and writing put spreads on the index with 0 days to expiration, meaning that the put spreads expire at the end of the same day that it is sold. The fund purchases long-dated, deep ITM call options on the index to establish synthetic long exposure to the index. Deep-in-the-money call options are those where the current index level is substantially above the strike price, providing the fund with price exposure to the index's returns, similar to owning the index's securities directly. These options typically have a high delta, meaning their value generally moves nearly 1-for-1 with changes in the index. However, their price may not always fully replicate the index's movement prior to expiration, which can result in tracking differences. The document goes on further, but we've already read everything we need to know. So what are these 3 ETFs going to look like when they do go live? Well, very simply, they're going to look and function very similarly to Roundhill's XDTE and QDTE. Roundhill and Defiance's ETFs are both going to use a synthetic covered call strategy and not a traditional covered call strategy. These synthetic funds are able to provide much higher dividend yields, actually pretty crazy dividend yields, but they're also incredibly risky and have huge price swings. The new Defiance funds and these 2 Roundhill ETFs have a 0 days to expiration strategy. That would involve writing calls in the morning and then closing them by the end of the day. The strike price they use will be above the current value of that day of whatever index the fund tries to replicate with its synthetic strategy. In the case of QDTE, which again will be similar to these new Defiance funds, it comes with a very high dividend yield, this one exceeding 20%. But the issue that everyone needs to take into account if you do want to consider one of these 0 DTE funds in your portfolio is that they struggle a lot to regain their share prices. If we look at QDTE, the Roundhill fund that mirrors the Nasdaq 100, and compare it to other traditional covered call funds and the index itself, we see the problem that exists. The index itself is in the dark blue line. After the tariff drama, when it came to share price recovery, we can see the other covered call funds outperform QDTE significantly. QQQI by Neos has been the best at recovering with its share price, and then after that is QYLD in a distant second. But even lower than that is QDTE. These types of synthetic funds have been really poor when it comes to share price recovery. They experience the exact same share price declines as the index, but they fare the poorest at share price gains. Unless these new Defiance funds do a better job at managing themselves, they'll all likely see similar results to what Roundhill currently has with their share prices. Now, these high dividends do help make up for the share price losses from a total return perspective. QDTE offers the highest yield out of all of these 2 funds by a pretty good amount, and if you reinvest the dividends, it's doing better than QYLD this year, but it still trails behind QQQI. Maybe they'll do something new with their lightning spread strategy that Roundhill hasn't done yet. We'll just have to wait and see at this point. Let me know if you think these ETFs are worth considering or if you already think they're worth passing up. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.